All opinions expressed by the Kendall Report participants are solely their opinions and do not reflect the opinions of VPM partners, and may have been previously disseminated by them on television, radio, internet, or another medium. You should not treat any opinion expressed on this broadcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of an opinion. Such opinions are based upon information that the Kendall Report participants and Robert Kendall consider reliable, but VPM Partners does not warrant its competence or its accuracy, or should it be relied upon such. The Kendall Report participants, VPM Partners officers, directors, employees, contractors, guests, are not under any obligation to update or correct any information on this broadcast. The Kendall Report participants are professional traders or investment advisor representatives who may be actively involved in securities herein on behalf of themselves, their companies, and their clients. Also, the opinions expressed by the Kendall Report participants may be short-term in nature and subject to change without notice. No part of the Kendall Report participants' compensation from VPM Partners is related to a specific opinion they express. Past performance is not indicative of future results. Kendall Report participants and VPM Partners do not guarantee any specific outcome or profit. You should be aware of the real risk of loss and following any strategy or investment discussed on this broadcast. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned in this broadcast may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this broadcast. Before acting on the information on this website, you should consider whether it is suitable for your particular circumstances and strongly consider seeking personalized advice. Nothing contained in the Kendall Report broadcast or VPM Partners on its website or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by any particular security, other investment product, transaction, or investment. Copyright 2017 VPM Partners and the Kendall Report, all rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic media in whole or in part is prohibited under penalty of law.
Now, for your host, Bob Kendall.
Welcome, everyone, to the Kendall Report for December 10th, 2018. And if you read my commentary, you probably wondered what was going on. I have an interesting history. I've been doing this for almost 40 years now, which is a little bit interesting. And I've seen a lot of things. And I was flashing back. In 1987, I wrote a newsletter that said, in September of 87, I wrote a newsletter that said, the risk reward in owning U.S. stocks was zero. Get out, right? And then in 89, I had another event, but we moved forward. And, in 2008, those of you who've been with me as customers or following my work know that I was yelling, how bad things are with the banks and everything is going. So I was flashing back. So what's happened over the years? And when I was doing commentary last night, all of a sudden, all the lights came on, and I was just like, oh my gosh, this is what's happening. So in 1987, the risk in the markets was the clearing firms. They were failing. Some of my buddies off the trading floor were running down the Federal Reserve buying T-bills, and they were getting negative rates in 1987, right, when rates were a lot higher, 10+% in some cases. And so as that happened, it was just kind of crazy. I'm looking at that, so I'm going to cover exactly what's happening here. So we had the clearing firms were the risk there. We spin forward to 89. We had the British were having all kinds of issues with the currencies. It was a mini crash. We called it the 1989 mini crash. But now we spin forward to 98 and 2000, which was the beginning of the dot-com. Of course, we all know in 2000 it was the dot-coms that burst. And then we spin forward to the famous 2007. And that was the banks that were at risk, and it had everything to do with mortgage and leverage and everything that we had going on right now. So what have we seen in the last almost 10 years? And when you put this together, I mean, to me, all the lights were on and going, oh my gosh, this is exactly what's going on here. So in all of those previous instances, everybody had the same trade on. It was a concentrated trade. Right now, we run about 10,000, a little bit over 10,000 unique portfolios in our software every day. And Mitch and I did a review some time ago, but nothing's changed a lot. Is there's about 12 symbols that everybody owns. And if you go out there in the retail world or advisor world, everybody that thinks that, this stuff is a commodity is wrong. It's not a commodity, and there's a lot of risk in it. So everybody's concentrated. And I mentioned in commentary that Jack Bogle, who founded Vanguard, has been talking for several years now how dangerous the environment is that we exist in. And so everything started lining up last night. And I actually, usually, I'm down by 10:30 at night. It was 1:30 last night, and I was still working on stuff and studying things. So what happened was I realized that everybody has the same position on again. Everybody believes the same, crap that, that everything's going to be okay and you buy the dips. Well, the dips aren't there. We just saw a 23-minute rally that goes from 83 all the way to 07, and now we're back at 94 basis the S&P. So there's a lot of things going on here that are becoming very real. And, and I'll go through when I get in the technical section and talking about the pattern that I've been kind of promoting for year end. All bets are off right now. And so what I realized is that the element in the markets that is at risk this time, this is going to sound interesting, are the mutual fund companies, the ETF companies. BlackRock is probably, talk about crosshairs on you, they are probably at most risk because if anybody panics, I don't think it's today, by the way, but I think the stage is set for an amazing, epic panic. Because if everybody starts selling out of, let's say a lot of folks start to sell out, 20, 30% everybody throws the get the hell out market orders in, just get me out of this stuff. And all these mutual funds have to rebalance all of these ETFs and everything that they have to rebalance. There's going to be massive selling in the market, and there's not going to be, and I'm going to show you some screens that's actually on there right now. There's virtually no liquidity in the markets right now. When we were going down to 83, we're only 10 handles off of that again. They're starting to sell this thing again. But when we were down there, there was, that liquidity meter that's on the right there, I'll just blow it up for a second so you can see it. But this thing here is absolutely, it was almost all flat bars down, and it shows what's there. But right now there's only 30, 40 contracts a side. Normally this is hundreds of contracts per side. So the bars are showing volume, but it's very light. You have to go 5 and 6 bids or offers deep to get to what normally is on the front, the closest bid ask that you have. And it's interesting because if you flash back to 2015, August 24th, we were actually at a retreat. We had about 30 of our advisors and a retreat in Sedona. And the market's we watched some of the ETFs drop literally 40 and 60% in minutes. And why? Because there was no liquidity. And the bids disappeared in the ETFs. It was, and it did rally back. It was a big spike. That was when we hit, I think it was 1812 or 1810 on the S&P. And this was a major event. And what we saw then, though, it was a glimpse into the future when liquidity disappears. And I harp about this a lot, but this is a very dangerous moment in time. And I just, like I said, I don't think it's today, although, we're back down 400 on the Dow Jones. There's a lot of pressure. There's plenty of people looking to sell these bounces. There's no more buy the dippers. You might have watched that rally for 23 minutes. I was watching it on this 1-minute graph I have here, and it was nothing short of, the inverse, where there was no liquidity. It didn't take a lot of contracts to move the E-minis or the S&P futures around. And so we're seeing some pretty serious stuff go on. And my expectation is, and I'll go into the technicals here in a minute, a couple other things I usually cover that I want to talk about before we go in there. But the bottom line is that this is the tipping point, okay? Let's talk about what's going on this planet. I don't care what side of the aisle you are on in this country. You're seeing a political faction trying to destroy a president of the United States. And if they do succeed in taking Trump down, you're not going to like what you see. If you're on that side of the aisle that you think that's a good idea, it won't be. There's nothing good about that, to have political instability in any country, anywhere. Okay, then let's flash the screen over to France. How are they doing right now? They're not doing well at all. And what you're seeing there is an uprise against the globalists. And it goes on and on. You're seeing all kinds of things going on in Germany, everywhere that you look, you're seeing this stuff. And then you look at the trade relations with China, this situation with Huawei. And by the way, I own a Huawei laptop, best damn computer I've ever owned. Thing's amazing. But, there's so much stuff going on there with all the 5G and spying and everything. We are at, in my opinion, at that tipping point where you have to be hyper focused. Okay, so good thing. VPM, you guys are doing it. If you've done your orders right, none of this that you're seeing on your screen right now matters, because you've been in cash, you're protecting your customers, you're protecting your business. That's all going. If you're not doing those things, then you've got some tough issues to deal with, because if you didn't sell when you should have, what do you do now? It's a very tough question to ask, because if there's the old Murphy's Law. If you sell here, it goes up. If you don't, it goes down. But there's some serious things going on. And I believe what we saw last week, where we just reversed in this massive amount of selling, was really a window into what it's going to look like in 2019. And so it's, hang on. It's going to be crazy volatility. This thing is going to be all over the place. And when I go through the details, we did hit some pretty key numbers this morning. We'll see how they play out. Like I said, I don't believe a collapse or a crash is going to happen today, but it literally can happen at any minute, because it only takes probably about 20 or 30% of the masses, depending on what's being held in there, to actually trigger to tip the dominoes over and start to get them to roll down. So I meant to do this first, but I've been at about 9 o'clock, hour before I normally start the show. I wanted to start an hour earlier, because this thing, we could have watched this all together, and I thought, well, no one's going to be ready for it, and so I'll just do it at my normal time. But before I go forward here, and we'll dig into the technicals and what's going on there, and we'll be covering gold and crude and all the stuff that we need to understand right now. I want to talk about the holiday schedule. Most of you have been around know I usually take the last 2 weeks of the year off. I'm not doing that this year. So what I'm doing is there will be Monday commentary for Monday morning, which is Christmas Eve. The holiday schedule, because of the restrictions of being closed more than 48 hours at any time, is really screwing up. There's no Monday, there's a partial day. Nobody will be doing much, but who knows what could happen on a day like that. But I will do a commentary on Monday the 24th and Monday the 31st. The rest of the week will be nothing. There will not be a broadcast for this show those days. So next week will be completely normal. And I got one more thing to go on and rant about, is that the Fed's going to be coming out next week, and everybody's kind of shifted things around. I have been just absolutely amazed how far down the 10-year has declined. But I think, and I didn't mention the Brexit, and I hear they pulled the Brexit deal off the table because it was just absolutely bogus. It had to be pulled. But I think a lot of the Treasury buying, a lot of things are coming out, are international bids that are coming in that are pushing rates down. And there's a lot of turmoil running around right now. This is not a simple moment in time, and there is a lot of risk in this. So let's go ahead and let's dig into some of the technicals here. So I already had this. I'm going to switch over here, and we're going to go over to this screen. And I left some models on here. In this model here, I can actually go short, or the VPM logic goes short, and this will be offered sometime early next year if you're interested. But we got a short the day that on Thursday when the market reversed to the upside. We actually got a sell on that reversal that day. So we've been short in this thing, and you can see we've been down to 2583.23. And this is probably the low of the day, but it's not the low of this move. We're likely to go down one more step, and I'm going to bring up quite a bit of stuff here on this section as we go through the markets. But the target minimum is around 2560. If you look at the commentary that I did, let's see here. Do I have that up? Yeah, let's just take a quick look at some of the numbers. I'm going to put that on screen here. So I thought, bear with me 1 second. What I want to show you is some of the numbers, and there's a cluster of numbers here that interesting. Bear with me 1 second. I think I need to change the contrast on this so you can see this just a little bit better. All right, this should be a touch better to be able to see this. But the numbers that I want you to see here is there's a cluster. There's 2569 here on the daily, 2550. We go to the weekly projections. We've got another 2567 as support 2 for this week. And then we have also, if we go to the monthly projections, you'll see 2608 was support number 3. We took that out this morning. That's pretty significant. And the extreme, 2560. So there's a cluster of numbers that are likely to support this market down around this 2560. We printed 2583 today, basis S&P 500. So this may be, coming to the bottom of this pattern. But I wanted to cover that because it's important to understand that while that's why I'm telling you, I don't think there's a complete collapse. I talked about over the last couple of shows that there was going to be, that it was likely that we were going to hold 2630. Well, we haven't. And we're back, this thing's bouncing all around. We were just 93. Now we rallied 10 handles. We're back at 2604. The problem with the configuration on the intermediate and long-term is that everything is turning south. Matter of fact, even the 200-day moving average is actually declining now. A lot of people just talk about the value of these averages. It's important to understand what they're doing. That tells you, as those of you who watch the show, I talk a lot about the angle of attack of a moving average, which tells you the likelihood of it being a resistance or support number. Right now, we've got major resistance, I've got it here somewhere on my sheets, 2740, 2735 in that range is the absolute ceiling. Last week it was 2800. We went 2807 was the number, and it went exactly to 2800, and then we saw, here we are at 2600, 200 handles lower on the S&P. So what you're seeing here is some mass acceleration. Right now on the daily, PPM2 is at 0.37. Anything below 0.25 is a trend. In this case, they're negative. And so we still have some sort of crisscrossing type patterns that are setting up here. But the bottom line is that we're seeing an acceleration to the downside. And we're also hitting on some of the numbers I was talking about. The minimum target is this 26, I'll get it right yet, 2560 to the 25, actually all the way down to 2480. We printed 83, that could easily be it. And I'll go back in a minute once I cover the daily, weekly, and monthly charts here on the live. I'll go back to the mocked up chart that I have to show you exactly what the levels are. And we may have satisfied zone 1, and I'll go through that in a few minutes. But let's take a look, and I'm going to take off the trading signals just for a second here. And let's go take a look at the intermediate graph. So the weekly, you can see here, we've got serious downtrend. PPM 1 is now at minus 1.05. That means that the weekly average is declining at 1.05% or minus 0.35 and minus 0.17. So two of the three primary trend indicators are in a negative or in a downtrend. Anything under minus 0.25 is that downtrend number. And that's also going to be your magic number. So the 10-week moving average is 27.05. That's going to be your ceiling. We're printing 25.99. So what we're going to see is maybe a rebound back if we can hold some lows, but it's highly likely that we're going to see this thing print down into the numbers that cluster at 25.60. And once it gets there, then we can set up some other pattern. But you can see here, this thing is rolled over big time, intermediate downtrend on 2 to 3 levels right now. Another week or so, we're going to see more acceleration of these trends. Now, those of you that recall, I've been talking about this sideways pattern that we were supposed to go through as 2018 is winding down. Well, all those bets are off. We took out the 2603. Unless we can rally massively, and the number would have to be, literally over 2652, which is not likely, I don't believe. Certainly anything's possible. But as long as we stay in that, what we did was an ABC, and now this is the beginning of the wave 3 down. Wave 3 down, and I'll bring this up in a minute, has a minimum requirement of going down to 2,300 on the S&P. That's another two handles. We're looking at probably another 5-7%. And we could end the year on this kind of note, depending on how things set up here in the next couple of days. We could see some pretty big pressure coming in year end. And then as we come into 2019, watch out. I mean, anybody remember 2008, how we started off? I believe it was, I think, a 16% decline in 10 days. So we're set up for some pretty ugly stuff, and I've been talking about the VPM database, how our strategies are set up. We're still hanging around 13% long. We got down to 9%, and a total database of nearly 18,000 symbols. We own nothing. There are no trends. There is nothing there. And these are how the markets act. This is much different than what we saw earlier in the year when we hit the March lows. Those lows have actually been challenged here. And let me just bring this March low up and get my cursor to work right. That was 2553.80. So we're coming down close to where we were in March. And I believe we will get to that, probably equal it. And then as 2019 happens, we'll see that taken out. We'll start to head toward other numbers like 27, 20. These numbers are happening so fast. 2460 is going to be a target. And then I'll go to this other graph in a minute. But you can see this downtrend is clearly formed. Not only is it clearly formed, we have massive amount of downward pressure in the markets. The PPM stand for price pressure momentum, and it tells about the angle of attack on a percentage basis, and then there's a matrix behind the scene that tells me what the probabilities of the market rising above or below a particular moving average based on that angle of attack, whether it's up or down. Right now it's all down, the trends are down, so that 2705 number is going to be the magic number. So let's go to the long-term charts. We'll go to the matrix of the different zones I set up. I did a special report. I actually edited it down. If you go to the Kendall Report channel, you'll see a video on there that says 26 minutes and change. That's an edited down version of the 54-minute. I took a lot of the flack out of this thing. And I was thinking about I'll probably update that report sometime this week. I've got some things at the end of the week, but possibly Wednesday I'll do a special show, and then I'll edit it down and try to get it to everybody. So as we look at this monthly graph, what you're seeing here is this thing is taken out to 21-month moving average. The next target is at 23.98, which is the 40-month moving average. And that tells us that we're likely to see this thing unfold probably first quarter of next year. The momentum on the downside, minus 0.43 on PPM1, which tells you there's a serious downtrend going on. The only other thing that's happening here, and if you've been watching the show for the last 4 years that I've been doing, I've talked about PPM3 maintaining 0.70. It's still 0.65. So if we do get down to these levels that I just discussed, you're going to see some pretty good support down here. But all of this momentum is dissipating very quickly. We have crossed through first and second derivatives over here on the PPMs. Let me go back full screen so you can see this. You'll see all three of these PPMs have cut through their first and second derivatives, which tells you that the potential for any sustainable uptrend is zero. There's no possibility at the moment with this configuration. And we start to see further deterioration in the prices, we're likely to see these accelerate as well, confirming that we're starting what I believe to be is a multi-year. This is not going to go away easy. We watched 10 years of a rally. We're going to get 4+ of a bear market that's going to take us down to levels I'll bring up here in just a second to talk about some of the actual matrix that I put together so we can talk about what are the possibilities here as we move forward into 2019 and beyond. But all the momentum, like I said, is pointing that way. So having said all that, let's go ahead and just bring up this chart here. As I talked about earlier, we've actually gotten very close to the 2558 is zone 1. Extreme 2483, I think I quoted 60 something, that there's been some updates in the pattern. So this is zone 1. So if we do reach this at this level, then the probabilities for a rebound back toward that 2705 or maybe even as high as 2740 exist early on in January. So depending on what happens here over the next several days, if we stay above 2558, then the probability of running back towards the 2740 is pretty strong. We take out 2558, which is where that cluster of averages that I talked about, we take that out, then we're going to see 2483. And that happens, then that sets the next scenario. Then the rally back just gets you back to the 26 something. You know, you're going to see 2640, 2625, something like that would be a rebound rally from that level. So this is not going to be a straight down situation. As I've talked about many times over the last couple of weeks, is these zones that are setting up are likely, zone 2 and zone 3 are most likely going to get hit in 2019. And those levels are 2370, 2325 is zone 2. Zone 3 is 2183 all the way down to 2028. And these things are going to happen, like I've said before, this chart is just set up so that you can see where it's going to go. This is not the exact formation that I'm projecting. These are just levels that we're going to reach. It'll be much more complex and much more structured to all of this. And this little gray zone I have in this chart is actually 4 years. So there's a lot there, and the scaling is is off from that standpoint. But I'm showing you where the probabilities are and where I think where they're going to be hit. So somewhere between Q2 and Q3, we'll see this 2325. Although we see a lot of numbers being accelerated. I've said this many times. I'll talk about a number, and it just gets reached because I mentioned it, it seems. But we're looking at this thing going all the way down potentially to 2180 to 2028. And there's going to be bounces, there's going to be tradable rallies, but as I've said many times, the probabilities of navigating this tree that I've got up here with ETFs and mutual funds is just about nil. Individual stock strategies will definitely be necessary to be able to even come close to this stuff. So as we're looking at this entire matrix here, there's very little upside. And as I just went through all of the live charts that I was talking about a minute ago, all of this stuff is set up perfect. As in the opening comments, I talked about all the turmoil on the planet. I don't know if you folks see the planet the way I do, but it's on the edge right now. There's a lot of folks on one side or the other that are really upset, and this division is very scary. And I had an interesting conversation over the weekend, and I believe, the Facebooks and the Twitters, something about Twitter just feels really aggressive. Like it feels like when somebody comments or trolls you a little bit, it feels like it's one of your best friends or somebody saying really nasty things, and it kind of really invigorates a lot of people just to go crazy on Twitter. Twitter is like really dangerous. Even Elon Musk is, and look at stuff that Trump does on there. It's crazy, and there's something about that feels so personal. But what's happened is it's got the entire world into this social crazy environment that is very volatile. And as I've said before, the only reason why our currencies, our markets, all this stuff works because everybody believes it works. When the belief systems click down to the next level, there's going to be more skepticism, there's going to be more volatility, and it's just going to get worse because you get people afraid and scared, they're going to run and they're going to do things they normally would not do. So let's switch over. That was fun, right? So let's go over and talk about, let's go to interest rates now. They're obviously big structure right now around this. So it's interesting because we'll go through the spreads here in a minute on the interest rates, but there's a lot of things going on. A lot of folks worried about the inversion of the yield curve. And when I go to yield curve, we'll talk about this. I've got the 10-year monthly. Let me go all the way to the short term. I think we're pretty close to bottom in yields. I'm actually very surprised that we got below, let's say, 292 range, 294. We're all the way down to 285. We've been down to 282. And this is way too far. The meter has swung too far over. And a lot of this, like I talked about in opening comments, has a lot to do, I believe, with Brexit, things going on in Europe. People are kind of scrambling, buying U.S. treasuries just as, the flight to quality or the safety trade. And I think that's out there in a big way right now. And so what I'm expecting to see this run back to probably 297, 303 is going to be a range. We've got next week, the Fed's going to be jumping rates. And I saw somewhere, I think the next rate increase was targeted for March of 2019. That's now dropped below 50% to happen. And we'll see how this all plays out. But for right now, rates are likely to stabilize somewhere around here. And that will help, I guess, to help to stabilize if this starts going. If rates continue to drop and we get an inverted curve, I'll talk about that more here in a minute, then we've got even more issues with what's going on. And right now, the bonds have actually been the biggest factor that we're looking at. They have been telling the story all along how bad things have gotten from the standpoint of market sentiment. So as we look at this daily graph, let's go over and take a look at the intermediate chart. And the intermediate chart is actually telling that story. You'll see I just was talking about the PPMs on the equities. You'll see right now we have a 10, PPM1 is at minus 0.20. That is a massive downtrend, telling you that we're not likely to get above that moving average for a while. It is declining, as I said, at 1.21%. It's currently at 306, and it is dropping. Let me just see what the rate of drop is, just roughly. It's dropping about 4 basis points per week. So next week, 302, the following week, maybe 298, and so forth. And there's a lot of momentum, and there's no sign. In fact, it's accelerating, not decelerating as this thing starts to go. So there's a lot of downward pressure, which with the Fed around the corner about to raise rates 25 bips, we'll go through that effect here in a minute. That almost ensures the potential, or that almost ensures that we will have an inverted yield curve. So we'll go through more of the technicals here, and then we'll go over and we'll talk about the curve and what the implications are there. So I talked about this and didn't really understand this 200-month moving average. Interesting enough, was the cap of this particular move to the upside. So right there we saw the 321, the high was actually 324, and then the next last month in November it was 324, 323.9, and now we've come back down. And what this is suggesting, you see that we're just basically a little flat, where if you look over in the far left-hand side of the screen, you'll see we're at minus 0.05, and that is not really a downtrend. So on a long-term basis, the trends are still sharply up for interest rates, and they're likely to resume this upward trend probably maybe Q2 or Q3, and we're going to stay well above this 21 period moving average, which is currently 264, and that's rising as well. So as we come into January and February, you'll see that pretty much where we are now, 275, 285 is going to be that bottom end of the patterns that are out there. And so as this unfolds, this is the real story of what's going on in the markets, and especially debt. If you did watch that show that I did on the long-term aspects, this is what I've been discussing, is that these long-term yields are going to really affect everything as we go forward. Earnings, just everything. There's $9 trillion worth of debt to be rolled over in the corporate markets. We've got an appetite with nearly $22 trillion of debt. The U.S. government is just sucking all the oxygen out of the room all the time with the massive amount of demand on money that they have. And I remember all the way back in 1980, that the conversation was then is that the Feds, because everybody thought the debt was big then, that the Fed and the government was going to literally take the money away from the corporate markets, and there wasn't going to be enough liquidity or interest in buying bonds to maintain the debt. Well, here we are, 30 some years later, right? That didn't happen, but we're now at a much different point. We have massive amount of debt that we've done. It's been growing constantly, literally since Reagan. Reagan kind of started this next growth of debt, and it just continued. It kind of flattened out a little bit in the late 90s, and then we came into 2000. Bush expanded it. We had, the Iraq War. We've had a lot of money spent, and then under Obama, he doubled it. And a lot of that happened to his defense is actually because of what happened in 2006 and the bailout of the banks, a lot of that just had to be spent to save us, so to speak. Unfortunately, the unintended consequences of that is putting us at great risk now, as we actually have that moment that everybody's worried about when I started in these markets in around 1980 was that there is going to be serious competition for money. And $9 trillion in corporate debt, I believe that's just here in the U.S. You go globally, and these numbers go exponential. So there is just a ton of things going on here, and the probabilities of this thing coming off the rails and the bond vigilantes showing up is really big right now. So let's take a look at, this is a chart, and I'll make this just a touch bigger. And this is a 10-2 kind of we'll call it an inflation indicator, but you see here that every time we've went underneath, not an inflation, but a recession indicator, every time we've went negative, we have had some pretty tough times ahead. We're really close. And like I said, with the Fed around the corner, I'm going to go to live charts looking at some of these numbers here in a second. But as this thing starts to unfold, if we do go this way, the other thing I want to point out is that all of these events were maybe 6-8 months of a negative inversion. It wasn't just a couple days. So we could see an inversion. There's still, as many people will point out, there's still a positive backdrop in the economy. But I keep saying this, and you guys need to remember this, the economy is not the market, especially on the equity side. This is a total different element here. But if we do go inverted, then we're going to see some of these things start to come into play. So let's go back over and let's take a look at the yield curve. And this is basically the 210s. We're down to basically 37 bips right now, and that is putting us at pretty close. We've actually upticked a little bit today, and I'll show you some other numbers there in a minute. But these spreads are really important, and those of you probably don't know my background, but from 1994 to 98, I ran a service for large bank institutional trading desk. And one of the elements, the banks never own anything outright. They're always spread something like the 210s. They're really bullish if their maturity gets a little bit over 4 years. They're always very tight, and they're spreading things off and doing that. What we're seeing here on these charts is really starting to put some stress on on the spreads, not only the spreads, but margins within the financial community. So it gets really interesting from here. As we look at the spectrum, just keep this chart up. I'm going to bring up, here's all the rates right here. And you'll notice that while they've all been declining, there has not been a big decline. This is a 13-week T-bill. And this is going to get bumped up. The Fed raises rates to 250 next week, which I have been talking about for multiple years, actually, that somewhere between 250, 275 is going to be a neutral rate, or where rates should be on a short-term basis. The issue is where should the long-term yields be during the same period of time? And what I'm expecting here is that we will see stabilization, like I was talking about a minute ago, as we were looking at the long-term yields. It's very likely that we're going to see a stabilization, and then sometime Q2, 3, maybe all the way into 2020, where we'll start to see yields start to come out of this spectrum, get above on a basis of 10-year, which a lot of people have focus on. Above that, we'll see a 360, 380 yield. None of that is off the table just on this short-term blip here, by the way. Looking at this is the 1030s. They have been steepening. That's helpful, but this is the 510s, and they have been stable. They're pretty flat. They've increased a little bit, but they're basically pretty flat as the spectrum goes on. So there's not a lot there as far as the longer term the longer term aspects of the Treasury yields are still exactly what they're going. So I've been going on about a lot of stuff. I want to touch on the Dow next, and then we'll work our way into some of the commodities to finish the show. And then, as I always do, we'll do some kind of a summary that comes up there. Okay, so let's go ahead and let's bring up the Dow here. So we'll look at the short term on the Dow, and you see it's been very stable. It's just been, actually, it's up 0.59 today. And one of the things I want to point out, if you want to figure out whether there's a flight to quality going on or not, if the Dow is going up and interest rates are going down, that means there's most likely outside foreign buying of the treasuries. So they're bidding the Dow to buy the treasuries. Typically, if you look at interest rate differentials and those type of things, there's some of that element in there as well. But what you see when you see this kind of configuration, it's real easy to figure out whether it's a flight to quality bid. And the Dow has stayed very stable while we've watched 321 all the way down to 382, right? So 382, that's a big move. That's 40 basis points on a 10-year in a very short order from the beginning of November until current. During that time, you can see Dow is absolutely flat. So there's strong bid in the Dow, it's not fading. So let's take a look at the intermediate trend. And the intermediate trend is actually telling us a couple things here, is that it's solid to the upside. In fact, there's Fibonacci projections right now. I always say I'm going to change these colors. Let me go full screen. It'll get a little easier to see. But those levels there are for a move toward the 101 to 106 level on the Dow index. And remember, this index it's heavily weighted to the euro. So that tells you that probably you're going to see some weakness. Maybe the euro is going to go back during that time, maybe to 107, something like that, 105. I don't see it going under par, but anything's possible, especially what appears from long away that the wheels are coming off Europe, especially in France, and the Germans are sitting kind of in the background, kind of watching what's going on there. It's finally become obvious that some of the migration issues that we've seen over the last, we'll even call it the last 10 years, are really starting to stress out some of the Western economies. But as we look at and go to the monthly long term, you'll see this is even more revealing. This thing is really rolling on the upside and also have objectives. I'll put this will be easier to see on screen. Also have upside objectives here that suggest that we're going to go to 102 to 105. So it's pretty much in line with what I was talking about on the daily charts and how they're looking right now. And so there's another element that I want to bring in. We'll bring in another elephant in the room, right? And that is gold, and I'll go through that here in just a minute. But that's another sign that there's a flight to quality going on. You got a rising Dow, and gold has went from 1160, roughly 1165.7, all the way up to 1250 plus. And that's the other sign that in spite of the Dow, you can see here increasing, it has very little relevance to what's going on. So let's bring up gold. Going to back up just a little bit and go to the daily graph here so you can get a better view of this. And like I said, we did print up, actually today we got up to 1256. That's been pretty much the high of this move. You can see everything and I've been talking about this for a while, using GLD, using this as a good hedge for some of the things that are going on with all of the turmoil that's happening around the planet. And this is usually also a safety trade. We all know that, and there's some nice movement. Also, like I said a minute ago, it's contrary to a lot of folks. Dollar going up, gold going up. Wait a minute, how does that work? It's not supposed to work that way. Let's take a quick look at the intermediate chart. You'll see this pattern evolve. We're now seeing 0.31, which is a uptrend on PPM1. The other two are still flat or negative, so there's plenty of resistance around 1240 or 1250 all the way to 1275. So we're not going to get above that, but when we do, the next range will be for a move to 1470 to probably 1500. And let me bring up the long-term charts here. And you'll see right here that we're sitting here right on resistance on the gold on a long-term graph. I'm going to point out a couple other things here. While the moving averages are just above there, we've got 1271, and that's definitely strong resistance. The PPM1, which tracks that average, so the angle of attack is a minus 0.74, which is still a downtrend. This is going to start to flip as we come into January and February. So in anticipating the changes in the gold market, it seems to be pretty easy. You also see that PPM2 is trying to turn up. It's minus 0.17, and PPM3 is, which tracks the 40-month moving average, is actually a positive 0.10. So what does this all mean? And what it means is that we're looking at the patterns, this trend that's been sideways literally since 2013. We've been in this range of, maybe 1470 high to 1170. It's been a long consolidation. I strongly believe that we could see 1800 plus and actually go into 2200. And as we start to see some of these events happen, this is going to be a big trade. And this is what's driving a lot when I look at these graphs and I do one of these shows like I've just done. All this stuff comes and makes sense. It's all, the puzzle is coming together. And one of the things that I've done forever and ever, and I've talked to you about this on the show before, is I'm always trying to figure out clusters, the story behind what's the fundamental story that would drive all of these things I just talked about, the equities down, interest rates up, the dollar up, gold up, what it's going to drive all that. And it's really all of this turmoil, the massive amount of debt that's piled up, and the realization ultimately that this is not a sustainable environment. And, I didn't mention this earlier, but it's certainly relevant. You got a Fed with a $4+ trillion balance sheet. There's nowhere for them to come in. Are they going to jack it up to 8 trillion? What are they going to do? Maybe so. I mean, the Japanese certainly have went nuclear and bought, not only, they bought everything that wasn't moving. They bought ETFs, they bought equities, they bought bonds, they've propped up their economy. And I keep telling everybody, watch Japan. Next show, next week, I'll make a point to kind of dig into what's going on in Japan. That's the time bomb. They may be also the leader from the debt standpoint when this thing really starts to come apart. And I believe that's going to be pretty significant place to watch and to get some feel for what's going to come across. And I'm working on putting a couple things together. Those of you who came way back when in the 2010 National Conference, I had Hugh Hendry as our keynote speaker. And everything the man said in 2010 has absolutely was spot on. It just, as always, when I was on the trading floor, they used to call me Dr. Given, but they didn't call me that until I left. And the reason why, I say it's given, it's going there, and they go, okay, smartass, when is it going to happen? And I go, I don't know, it's just going to happen. It's the same thing with you. You have a very long-term viewpoint of the world. And the things he said, you think, well, he said it, so it's going to happen in 6 months or a year. Well, it's been, the better part of 9 years ago that event happened. And he's since closed his hedge fund. He's kind of went incognito, completely underground. I have no idea what he's doing. I've tried reaching out to him, have had no luck. But the point is that these long-term forecasts, the expectations of you watching this show or reading my work or whatever, that it must be happening, immediately because I said it. A lot of these events are things that are going to unfold like super slow motion. It's almost like watching, the joke, watching paint dry or watching grass grow. It's a very slow process, but I think everything is at that tipping point. We're going to see an acceleration in a lot of these concepts, a lot of the risks that we've all talked about. We know it exists. We just kind of slough it off and go, okay, everything's okay because nothing's happened yet. And when we get the most complacent, and maybe we're around that point, that it's all going to be okay, you can, like I was saying to somebody I was talking to earlier this morning, there's nothing on a television set that's going to actually tell you what's going to happen. All of these, most of the people on CNBC, Fox, whatever, in Europe or whatever you see, work for a mutual fund or they work for a financial institution, and of course they're going to say it. It's like if you read, like LPL's research, which is somewhat of a joke. It's very mainstream. Everything's going to be okay. Well, it's not going to be okay, and especially with all the attacks, political, the attacks against the globalists in Europe, and all the stuff that's happening. Maybe it gets under control. I hope so. I want to be wrong, actually, but everything is pointing to this event actually getting worse. And while I'm talking, the S&P has rallied all the way back to 2623. So, like I said earlier, we'll go and just summarize the show, and I'll call it quits here. But very likely that 2583, if that's the low, we can run all the way back to 2705 to 2740 from here. And I'll be covering this on my daily commentary. And like I said, I'll watch this thing very closely just to see exactly how it's going to unfold. So, but don't think it's all okay because we're rallying back here, because this is, like I said earlier, this is most likely from the S&P viewpoint where we hit some key numbers. We're going to consolidate. We're going to stay under 2705, and then the next leg down to 2480, 2460 is likely, and then we'll see another rebound. This is not going to be a straight line unless we hit some trigger point and something happens that everybody panics. And with the panic of a lot of players that all have the same position on that I talked about, you get the machines in there, you get the AI, the HFT guys, you get all of that piled up against the market. Bad things can happen. There's no reason, actually, to be excited and be looking to buy this market. There's nothing on the horizon. I talked about the reverse fundamentals. There's nothing on the horizon that you could look forward and say, oh, this is why everything's going to be okay. It's almost impossible to see this. The Democrats aren't in control yet. They're already gearing up to attack Trump. That's all they care about, is to take out Trump. They actually believe Russia had something to do with it. I'm not saying Russia hadn't done things trying to do it, but it's just the whole thing is ridiculous, and maybe it's as ridiculous as maybe Obama's birth certificate, right? It's just like the right certainly attacked Obama for years, but this is much different. There wasn't a special counsel. There wasn't the elements where these things have happened. So the political ramifications of what we're dealing with here can absolutely be seriously impactful, and there's no way to predict it. There's no way at all to try to figure out what's going to happen here, okay? So other than we stick with the technicals, we look at the kind of summarizing everything, the database with VPM being at 13%. We don't own a lot. There's no trends around. Anything you're buying is a scalp. because there's not going to be any intermediate or longer term aspects at the moment. Certainly there's some individual stocks that do well. Not everything's going down. But as I've said many times, if you read my commentary, is that there are things that have occurred with our database flipping so quickly all the way down to 9%. That's only 2% better than it was in 2008. I'm just amazed at how many trends, how much has occurred in our database to get to that level. And when we got to that number, that was around Lehman, okay? And so there was another 6 months of turmoil in 2008 and 9 before we actually finally seen a bottom. And that only happened because of TARP and because of the Fed stepping in and pumping in massive amount of money, trillions of dollars. They don't have the money to spend today. We certainly can't afford to finance another rebound. I don't know how that would be pulled off and what they could tell you and me that would make us believe that what they're doing is the right thing. I think if the Fed backs off rates, they start to change their rhetoric, it's going to freak people out more that things are getting worse, and the inverse effect is going to happen. I think they've painted themselves in a corner, and there's no way out. So with that great thought, I will let you folks go. I will, like I said, next Monday will be the final show for the year. And then as far as commentary goes, after next week will be normal commentary every day. And then the following Monday, which will be Christmas Eve, there will be a report, might be abbreviated depending on what's happening. And the same thing on New Year's Eve on the 31st. And then start daily commentary right off the bat on the 2nd and 4th because we have this middle of the week thing. So everything will be starting off in 2019. So anyway, we'll see you next Monday. I do have plans on doing a special report probably this week, depending on what happens, and we'll see what it sets up. Thanks again for watching. I really appreciate everybody participating, and some of the comments that I've had has been very helpful. Thanks again.